On November 2, 2022, a financial publication called CoinDesk published a leaked balance sheet. It was 11 pages. It showed that Alameda Research, a trading firm closely linked to the cryptocurrency exchange FTX, held most of its assets in a token called FTT. FTT was not an independent asset. FTT was a token created by FTX itself. Alameda's balance sheet was largely made up of money that FTX had essentially printed. Nobody outside a small circle of insiders understood what this meant. Within a week, everyone did. On November 6th, Changpeng Zhao, the chief executive of Binance, FTX's largest competitor, announced that Binance would sell its entire holding of FTT tokens, citing concerns about the leaked balance sheet. The announcement triggered a bank run. FTX customers attempted to withdraw $7 billion in a single day. The exchange could not honor the withdrawals. The money was not there. On November 11, 2022, 9 days after the CoinDesk article, FTX filed for bankruptcy. The firm's valuation had been $32 billion. It was now worth less than nothing. An estimated 1 million creditors were owed money that did not exist. Sam Bankman-Fried, the 30-year-old founder and chief executive who had been celebrated as the face of responsible crypto, who had donated tens of millions to political campaigns and sat next to heads of state, who had appeared on the cover of Forbes and been compared to John D. Rockefeller, was arrested at his penthouse apartment in the Bahamas at 5 a.m. He was wearing shorts. This is the story of the fastest major financial collapse in history, and the fraud that made it possible. Sam Bankman-Fried grew up in California, the son of 2 Stanford law professors. He studied physics at MIT, then joined a quantitative trading firm called Jane Street Capital, where he learned to think about markets in terms of mathematical expected value. He became interested in cryptocurrency not as a believer in the technology, but as an arbitrage opportunity. In 2017, he noticed that Bitcoin was trading at significantly different prices in different countries, as much as 30% higher in Japan than in the United States. If you could buy Bitcoin cheaply, move it to Japan, and sell it at a premium, you could make substantial risk-free profit. He founded Alameda Research in 2017 to exploit this opportunity. The Japan Arbitrage eventually closed as the market matured, but Alameda remained active as a crypto trading firm, using aggressive strategies to generate returns. In 2019, Bankman-Fried founded FTX, a cryptocurrency exchange intended to offer more sophisticated trading products than competitors like Coinbase. He recruited aggressively, moved operations to Hong Kong and later the Bahamas, and built the exchange into one of the largest in the world. By 2021, FTX was processing billions of dollars of trades daily. It had signed sponsorship deals with sports teams, arenas, and celebrities. The FTX Arena in Miami, formerly the American Airlines Arena, home of the Miami Heat, cost $135 million for the naming rights. FTX ran Super Bowl advertisements. Tom Brady was a brand ambassador. Sam Bankman-Fried, known universally by his initials SBF, had a net worth estimated at $26 billion. He wore cargo shorts to meetings with regulators and senators. He slept on a beanbag in the office. He talked constantly about effective altruism, the philosophical movement that holds that the morally correct use of money is to give it away as efficiently as possible to save the most lives. He said he planned to give away almost all of his wealth. At the center of the FTX collapse was a relationship that most of its customers did not know existed. FTX, the exchange, and Alameda Research, the trading firm, were supposed to be independent. FTX held customer funds, money deposited by millions of traders around the world who used the platform to buy and sell cryptocurrency. Those funds were supposed to be ring-fenced. No exchange could use customer deposits for its own trading activities. That was the foundational promise that made FTX trustworthy. The promise was false. FTX had been lending customer funds to Alameda Research. Billions of dollars that belonged to FTX customers, money they believed was sitting safely in their accounts, had been transferred to Alameda and used for trading, investments, real estate purchases, political donations, and personal expenditure by senior staff. The scale of the transfers was staggering. Prosecutors would later allege that more than $8 billion of customer funds had been misappropriated. Caroline Ellison, the chief executive of Alameda Research and Bankman-Fried's former romantic partner, would testify that she had been aware of the arrangement and that SBF had directed it. The FTT token was the mechanism that concealed the problem. FTX had issued FTT and inflated its stated value. Alameda held large quantities of FTT on its balance sheet, which made the firm appear solvent on paper. But FTT's value depended entirely on confidence in FTX. And when that confidence evaporated, so did the asset. The entire structure was a house of cards built on a token the firm had invented. One of the most striking features of the FTX collapse is the gap between Sam Bankman-Fried's public image and the private reality of his firm. In 2022, SBF was arguably the most politically connected figure in the cryptocurrency industry. He had donated approximately $40 million to political campaigns, making him, by some measures, the second largest individual donor to Democratic causes in the 2022 midterm cycle, after George Soros. He testified before Congress. He appeared on panels at prestigious conferences alongside former presidents and prime ministers. He wrote policy proposals for cryptocurrency regulation and submitted them to regulators. His stated goal was to shape the rules of the industry in which he operated. Regulators found him thoughtful and credible. Journalists described him as the adult in the room, the crypto entrepreneur who actually took risk management seriously. Media profiles emphasized his modest lifestyle: the beanbag, the cargo shorts, the vegan diet, the stated intention to live on almost nothing and give the rest away. Meanwhile, FTX executives were spending customer funds on a $30 million penthouse complex in the Bahamas. Bankman-Fried's parents had been gifted a property there. Key staff held equity stakes in companies purchased with what would later be revealed as customer money. The gap between the image and the reality was total, and it had been maintained successfully for years through a combination of genuine charisma, deliberately cultivated accessibility, and the general willingness of sophisticated people to believe that someone this earnest, this nerdy, this publicly committed to giving money away, could not possibly be stealing it. On November 6, 2022, Changpeng Zhao, known as CZ, tweeted that Binance would liquidate its FTT holdings. The tweet had the force of a detonation. CZ framed it as a risk management decision following the CoinDesk report, but everyone in the market understood what it meant. The largest figure in crypto did not trust FTX. Within hours, FTX customers began withdrawing funds at a rate the exchange could not sustain. Bankman-Fried initially tried to contain the crisis. He tweeted that FTX's assets were fine, that withdrawals were processing normally, that the firm had sufficient liquidity. None of this was true. Within 24 hours, FTX had suspended withdrawals. Binance briefly announced it would acquire FTX to bail it out. Due diligence lasted less than 24 hours. CZ walked away, citing the scale of the mishandled funds and ongoing regulatory investigations. No other buyer emerged. On November 11th, FTX filed for bankruptcy. John J. Ray III, the restructuring expert who had overseen the Enron bankruptcy 2 decades earlier, was appointed chief executive. He would later tell a court that in 40 years of legal and restructuring work, he had never seen such a complete failure of corporate controls. There were no financial records. There was no accounting system. Senior executives had communicated via an application that automatically deleted messages. Loans had been made to individuals using a software backdoor that concealed them from audits. Sam Bankman-Fried did not flee. He stayed in the Bahamas after the collapse, gave numerous media interviews, and appeared to believe, or at least wanted others to believe, that what had happened at FTX was a management failure rather than a crime. He tweeted obsessively. He gave a long interview to a journalist in which he appeared to admit that the effective altruism framing had been, at least in part, a public relations strategy. He seemed unable or unwilling to stop talking. On December 12, 2022, Bahamian authorities arrested him at the request of the United States government. He was extradited to the United States in late December. His former colleagues cooperated. Caroline Ellison, the Alameda CEO, pleaded guilty and agreed to testify for the prosecution. Ryan Salami, FTX co-CEO, pleaded guilty. Nishad Singh, the head of engineering, pleaded guilty. Gary Wang, the co-founder of FTX, pleaded guilty. The trial of Sam Bankman-Fried began in October 2023. It lasted 4 weeks. On November 2, 2023, exactly 1 year after the CoinDesk article that had triggered the collapse, the jury returned guilty verdicts on all 7 counts of fraud and conspiracy. In March 2024, he was sentenced to 25 years in federal prison. The FTX collapse caused damage that extended far beyond its immediate creditors. Approximately 1 million people had funds on FTX that they could not withdraw. Many were small retail investors, people who had moved savings into crypto during the bull market of 2021, believing that FTX was one of the safe platforms, the regulated exchange, the one run by the serious person in the cargo shorts. The collapse wiped out an estimated $8 to $10 billion of customer funds. Bankruptcy proceedings would go on to recover a significant portion of this, a rare outcome in financial fraud cases. But recovery took years and came at reduced value compared to the original deposits. More broadly, the FTX collapse accelerated a regulatory crackdown on the entire cryptocurrency industry. Banks that had been cautiously exploring crypto services retreated. Institutional investors who had been moving into digital assets paused. The reputational damage to the sector was immense. Several major crypto lenders and funds that had exposure to FTX, including BlockFi, Celsius, and Genesis, also collapsed in the aftermath. The contagion spread through a crypto ecosystem that turned out to be far more interconnected and far more fragile than its participants had claimed. Sam Bankman-Fried built something that looked, from the outside, like exactly what the cryptocurrency industry claimed to need: a regulated, professional, trustworthy exchange run by someone who seemed to genuinely not care about money for its own sake. It was a performance. The regulation was lobbied for because it would disadvantage competitors. The trustworthiness was a fiction maintained by deleting messages and concealing transfers. The indifference to money was, in the most literal possible sense, a lie, because the money was being spent on real estate, on donations, on political access, on a lifestyle that the effective altruism framing was designed to make invisible. The deeper lesson of FTX is not about cryptocurrency specifically. It is about the power of a compelling narrative to suspend normal due diligence. FTX's auditors, investors, regulators, journalists, and celebrity endorsers all had reasons to look more carefully. Almost none of them did. The Sequoia Capital Fund that invested $214 million in FTX published a glowing profile of Bankman-Fried after their meeting, describing the session as one of the most mind-expanding of their lives. They deleted it after the collapse. $32 billion, 1 million creditors, 9 days. The cargo shorts were in the laundry. The beanbag was a prop. The altruism was a story told to people who wanted to believe that someone this rich could also be this good. They weren't the first. They won't be the last.